Good afternoon, everyone. Myself, Ram Kumar, welcoming you all to this webinar on our twin NFOs that we are launching on 26th. So these are smart beta ETFs that we are launching, namely HDFC Nifty 200 Momentum 30 ETF and HDFC Nifty 100 Low Vol 30 ETFs. So, so we've recently launched and we have recently closed our other three smart beta NFOs, namely quality, value, and growth, which are based on the fundamental attributes of a business. And these two NFOs, these two are also smart beta ETFs, but these focus on attributes which are related to the stock price movement, namely momentum and low vol. So as the name suggests, the Momentum 30 ETF will pick up stocks that are currently in favor or currently performing well based on some statistical parameters. Whereas the low vol 30, as the name suggests, will try and pick up stocks that have undergone lower volatility as compared to the broader market. So there are predefined parameters according to which these indices are formed. And as you all know, this is an ETF. These two are ETFs, which will try and mimic or identically form portfolios in line with the underlying indices. So these are why these are called smart beta, because these are factor-based investing. So we will detail that as we progress with the presentation. So just before I hand over to our fund manager, Mr. Krishan Daga, who is here in this call, just wanted to share one thought, is that momentum and low vol are kind of contrasting investment ideas. So one you can say is, so we have all heard about this attack and defense strategy. So similarly, you can view or draw a parallel in terms of momentum and low vol, as one is a slightly aggressive strategy, one is a slightly defensive strategy. So that's why we have launched these two strategies together as a twin NFO, so that you can take you can invest in both of these strategies together, say maybe 50-50 in both of these strategies, and get an overall all-round portfolio. So like we have launched the QBG, now this is momentum and low vol, in which you can invest in both of them. The question as to which one is better does not come. So both have their own purposes, both have different investment themes and ideas. So that is the background as to why we have come out with this as a twin NFO. So with that, I will hand over the floor to the fund manager, Mr. Krishan Daga, who is our main speaker for the event. And I've also got my other colleagues, Shikhar and Siddharth, who are ETF specialists. So if there are any questions, we'll handle them. We'll dig them up at the end of the session. I'll take their help also to answer this question. So with that, over to you, Krishan ji. Please go ahead.
Thank you, Ram, and good afternoon, everyone. In this presentation, we'll talk about two smart beta products, which is Nifty 200 Momentum 30 ETF and Nifty 100 Low Volatility 30 ETF. So first of all, what is a smart beta investing? It's simply, these funds are passively managed. Here, stock selection and weightage is based on some predefined factors and methodology of the index. Based on that, we select the stocks and we give them the weightage, and accordingly we invest. These factors are basically here, like in these two ETFs, you can say we are using momentum and low volatility. So what is momentum factor? If I explain it little more about that index, here, we buy stocks which have high normalized momentum score, and how that is calculated, it's simply 6 to 12 months price return and divided by standard deviation. That's the way how we calculate the momentum score. And in following pages, I will explain you further. And the low volatility, where we buy stocks with relatively stable price movement. Again, metrics which we are using here is simply standard deviation of last 1 year. So in the momentum, what we are using is a 6 months and 12-month price return, and that is divided by standard deviation, while here it is a standard deviation of last 1 year price movement only. Now, why smart beta investing? Again, in a normal, ETFs, if you will see, they are following the market cap strategy, while in a smart beta, we are using the factors. Ram have also explained that in the beginning that why, it is different, and why it is called, smart beta, because we are using the factors here. And when we do this research, lots of research behind that it is there, which shows that this smart beta products are generally giving you better risk adjusted return compared to your market cap weighted indices. So there's a lots of um, uh, extensive research is behind that, and that also shows that in last 5 years the if you see the size which have grown up, from 500 billion to 1.36 trillion, which is almost, basically 22% of the CAGR. If you understand little bit momentum and low volatility more, then what is momentum? Momentum refers to the tendency for stock price trends to persist over time. So here, we try to capture those stocks where in last 6 to 12 months, basically where price return is adjusted on a it's daily price return, but it is, capturing that momentum here in those, stocks. But in the low volatility is slightly different. Here we are, using the strategy which selects stocks, which is relatively stable price movement over the last 1 year. So there is a difference between two strategies, definitely. And if you look at the momentum, why momentum? Because momentum index adopts basically changing in the market condition as the stock market winners keep changing. Because here, the stocks will be not same every time because of the price movement, because of their fundamentals. When the results come, so sometimes the stocks are expensive at particular price, sometimes it is expensive. So this winner keep changing, in the momentum. So here, you can say that turnover of, this particular index will be also more. So any particular sector which is not doing well will be out of the, this index at times, and any index or any stock which is doing which is performing better, and where we believe that it continues to perform better in the following months as well, then that those stocks or those sectors becomes a part of the momentum. At the same time, in the low volatility, if you see here, those stocks are selected which have performed better or in line with Nifty 100. But at the same time, we see, in a long run, where the stable price movement is there. So that's a big, difference between two, strategies here. With the name, it is very clear, Nifty 200 Momentum 30. So here the universe is the Nifty 200, and out of which 30 stocks are selected. While in the low volatility, it's a Nifty 100 low volatility. So the index or universe is the Nifty 100, out of which 30 stocks are selected. What are the metrics we are using? I have explained in the previous slide as well, that 12 months momentum ratio and 6 months momentum ratio for the momentum 30. And here we are using only, volatility that is as defined as a standard deviation of daily price returns for last 1 year. So that's the difference. Now, if you look at the returns here, momentum and low volatility indices, how they've given the return or how their sectors or let's say constituents have performed. If I take one example, let's say of the FMCG sector, where right now, if you will see Nifty 100 low volatility is having 25.4% weightage. You can see here, which is marked in a green in the middle of the table on the left hand side. Now, if you compare with the, let's say, index, let's say Nifty, 50, where the weight is only 8.8%. So these sector is definitely, have given a stable growth in the past. And that's why, here, volatility is also low. So the weightage is higher. But at the same time, if you now compare information technology, where the weightage of the Nifty 200 momentum is absolutely zero, compared to Nifty 50 weightage, which is 14.2%. Now you can see, here, if you see the data of, let's say, IT index, in last 6 months or 1 year, this IT sector is not, performed well, and that's not a part of the momentum. So in momentum, they try to capture, those stocks or those sectors which are doing better or which can do better in the following months. So that's a difference, compared to other, index. Now in the low volatility, here you are having the weightage, but ultimately, as we have said, they are the more stable. So there's a definitely, two different indices are there and two different strategies are there, and we need to understand that more in the following slides as well. Now, if you compare the returns, let's say for a longer period, let's say 1, 3, 5, 10, 15, all returns we have given in the period. But if you look at the just 15 years return of Momentum 30, it is 16.6% vis-a-vis with the Nifty 50, which is only 11%, which means that there is a outperformance of 5.6% for last 15 years. That's huge outperformance for the momentum. As I said, that momentum tries to capture, all the, stock which is performed, which has performed in, last couple of months, and they have a tendency that they can outperform, in the following months as well. So only those stocks are selected here. At the same time, if you see, Nifty 100 low volatility, even their returns of 15 years is 14.8%. Even that strategy is outperforming to Nifty 50 by almost, 4%, because Nifty 50 is only 11% compared to that Nifty low volatility, which is 14.8%. So almost 4% kind of outperformance. So we can say that Nifty 200 Momentum 30, or let's say Nifty 100 low volatility, always outperformed in last 15 years. So they have a track record. Great track record is already there now. Not only 15 years, even if you look at 10, 5, 3, for across all the periods, like these two strategies are outperforming to your Nifty 50. Now, if you look at the basically last 15 years, every year's data out of 17 years data which we have given here from FY06 to FY23. FY23, of course, it's only financially to the date, but even up to FY22, if you see, there's a 17 data points are there, out of which 13 years when your momentum have given the better return compared to Nifty 200 or Nifty 100, both, like that way. At the same time, if you compare, let's say Nifty 100 low vol 30, out of 17 years, in the 10 years, they have outperformed to Nifty 200, and in 9 years, they have outperformed to Nifty 100 as well. Here we are showing the average rolling return. We are showing the standard deviation of rolling returns and return risk ratio. Now, if I compare as a one example, let's say for 10 years, the rolling return itself is 18.5%, and if I compare that with the, let's say, Nifty 50, it is only 11.5%, which means that there is a 7% outperformance is there if you compare the rolling returns. If you compare with the low vol, still it is low vol. Low vol have outperformed to the Nifty 50, because Nifty 100 low vol 30 is given a return of 15.7% compared to Nifty 50, which is only 11.5%. So again, almost 4% kind of outperformance. This slide is also one important point. If you look at the standard deviation now, many times we look at the return, and where if I look at the return, I will always see that Nifty 200 Momentum 30 have given a better return, especially if I compare with the low vol also. But if you see the standard deviation of rolling returns, and especially for low vol, in all periods, it is much better compared to your all other basically, let's say, competitive index, whether it is Nifty 50, 100 or 200. Even if you compare with the Momentum 30, here standard deviation of rolling return is far lower compared to all other parameters. At the same time, if you see return risk ratio, now that is also very important, because how your returns are stable, it is ultimately you can find it here. So always, that of the low volatility is always better. So when I look at the return, obviously, it is coming with certain, risk, like, so return is not always, higher without any risk. And as Ram have mentioned, that these two funds are, one of the fund is, let's say, to attack and one is to defend. So of course, momentum where you are, chasing the return. So your risk is little higher compared to your low vol, but at the same time, low vol is giving you the stable return. So that as a defense, you can have that strategy. So both the strategies are very, very important here. And you can again decide to have either 50% of the allocation in both, or depends on your risk profile, you can decide that. But yeah, both the strategies are having their own advantage and disadvantage at time, because return whatever we are getting here in the momentum is not necessary that it is coming without risk. So risk is always higher because standard deviation, or if you see the return ratio is much higher compared to your Nifty 100 low vol. So my suggestion, basically both the strategies should be used, and then you should decide that how much percentage you want to invest in each. Or even if you are investing, let's say 50-50 in both. There's a one slide I would like to show you here, that if you take let's say 50% in both, and if you compare the return of let's say 10 years, these two strategies, combined strategies, have given a return of 17.2%. If I compare that same with the Nifty 50, it is 11.5%, which means that I'm still getting almost 6% kind of alpha here on a combined strategy. So it is very important that all the investment can't have can't chase the return only. So there has to be a some portion where I'm chasing the return, yes, and I'm investing in a momentum. But there could be some portion where I'm investing where I'm getting the stable kind of return as well. Now look at the numbers, financials numbers of these two indexes, which is also very, very important. And I will try to tell you how they are different, strategies, and how, we look at these numbers. So if I look at simply, let's say Nifty 50 price to earning, which is 21 times at this point of time, and these are the all August end numbers. And if I compare with the price to earning of, let's say, momentum now, which is 20.3, which means that here stocks, which is a part of the momentum, are having a attractive valuation in terms of P compared to your Nifty 50. Or in fact, if you compare with Nifty 200, then 22 times, that is there. So it is further, attractive if I compare with Nifty 200, because here your universe is Nifty 200. So the real comparison, if I compare, apple to apple, then it is 200, which is 22 times. And here it is only 20 times, which means that this index is trying to select those stocks which are attractive in terms of price, or where, you can say that, these are the stocks where your price upside in the following period will, or outperformance will be far better compared to, other stocks, which is not a part of this momentum. But at the same time, there's another ratio. If you will see the return on equity, now return on equity will be showing you completely different story. So in the Nifty 100 low vol, the return on equity is 25.9%. And if I compare that with the Nifty 200, it is 18% only, which means that there's 8%, ROE is higher in the Nifty 100 low vol. Again, that's why I'm saying how, this becomes a defensive, portfolio, because here those stocks you are selecting, which historically have given, stable return in terms of return. And obviously this, these companies are having better ROE and price to earning also. It is not very, very expensive. It is slightly expensive, because if you are looking for those stocks which have given the stable return, generally those kind of stocks are, available at a expensive, price compared to the stocks where the volatility is much higher in terms of their profit growth, earning growth, or in terms of, their price movement. So obviously, these two parameters are very, very important to see. So again, I'm repeating as a, I'm summarizing this, that price to earning of momentum index, you have to compare with the Nifty 200, which is very attractive, and at the same time Nifty 100 low vol, where you have to see the ROE kind of, because you are investing in those companies which have given a stable return. And if you compare, it is almost 8% higher that way. At the same time, quickly on a price to book, if I see, 4 times, in the momentum, Nifty 200 is also 4 times. So you are not, buying in terms of price to book. It is not very, very expensive, this momentum stock. 100, as I said, it will be always, because they are giving the stable returns. So generally, they are the expensive. So here it is 4.86. Dividend yield, if you see in both the, index, it is far better than your Nifty 200, yield, because Nifty 200 is giving only 1.44%, while your momentum is giving 2.08% and low vol 30 is giving 2.13%. So these fundamentals, are very, very important, because when you are investing in the smart beta product, as Ram have said that our previous three NFOs, where we were using fundamental in all three products, but here we are not using the fundamental. We are using the price or momentum, or let's say low vol strategies. But still, if I before investing, if I look at the numbers are also very, very attractive in terms of price to earning of momentum, or let's say ROE of the low vol 30. Now sector comparison. Now sector comparison is also very important, because when I am talking about the selection process for, let's say, momentum or let's say low vol, both these strategies, how they are selecting the sector. So one example I will take it here for Nifty 200 Momentum 30. So this chart is, first of all, let me explain. This is only for the Nifty 200 Momentum 30 index only, because this I am showing you as an example. Now that on the top, the bar which you are seeing, it is for the IT index. So in 2018, if you will see, in the momentum, we were having this index was having a higher weightage in the IT. Similarly, in the 2020, also there was a higher weightage in 21, where this index have IT index have given a great return. So it was, overweight on at that point in time. But if you see the now, current, index, where IT is not even, a part of the this momentum index. The reason behind that, because here, as I said earlier, that we pick up only those stocks, those sectors which have performed better in the last, half year, and which is having a trends to, perform in the following, quarters or following half year as well. So here, I can show you this example, this table, as I showed that, IT is having a 0% return right now. This is what reflecting in this table as well, this chart as well. This chart is showing 5 incidents which we have taken. Let's say, what happened in, let's say, momentum index, or let's say low volatility compared to, your Nifty 150. So in the previous slide, we have taken an example of Nifty 200 Momentum 30. Here we have taken an example of Nifty 100 low vol, and then we have compared, Nifty 100 low vol with the other, indices, which is Nifty 100 and Nifty 50. So there are 5 incidents. We have given the, numbers of all 5 incidents, how, your Nifty 100 low vol in the crisis time or in the stress time, how it is outperforming better. Because as I said, that momentum is doing better at a different time, but low vol is always at the time of stress, or let's say it is giving you a stable return as well. So it is, outperforming. So I'll take a one example. Let's say if I take an example of global financial crisis, which happened in 2008. In that, period, if you see the return of Nifty 100 low vol, it was down by only 45% compared to your, Nifty 100 or let's say Nifty 50. They were down by almost, 57.5%. 100 was down by that much, and even Nifty 50 was down by almost 56%. So there was an outperformance of more than 10% at that point of time, which is huge. That is why we are suggesting that both the strategies are important at times, because in such time, in such kind of stress time, your low vol is always, giving you better return compared to your, broad-based indices. And not only that, it is giving a great alpha in such times, in the stress time. So that is why Nifty 100 low vol also very, very important index, and you must, look at this data, all other data as well. This slide I've already explained. If you make a combination of, let's say, 50-50% in each, then how your returns are. And as I explained, that 6% of outperformance you are getting here as well. Why to invest in momentum and low volatility ETFs? as we have explained earlier, that these smart beta, all strategies. Before we come to you, we also do the back testing, and it is anyway. Even the index companies, they do lots of research behind this, and thereafter they create the index and they see how at times these index can give you better return compared to your broad-based indices. So generally, the average return, if you will compare, let's say from the broad-based indices, this smart beta products are giving higher return. And here also, diversified across, factors. So as we have said that, whether you want to, invest in a value strategy, growth strategy, or quality, and now we are coming out with the momentum and low vol as well. So there, various strategies. These strategies can be used based on your risk profile. You can decide how much you want to invest in these ETFs. And but these are the five strategies. Let me add here. These are the most popular ones. These five strategies. And right now, we are coming out with these two, and recently we have closed the other three. Just quickly on the HDFC Nifty 200 Momentum 30 ETF and HDFC Nifty 100 Low Vol 30 ETF. First of all, why ETFs? Because there are multiple ways to invest in the, let's say, whether it is active funds, passive funds, equity funds, debt funds, commodity fund. Now there are too many, too much choices there. But when you are investing in the ETFs, it is very, very simple. Here your objective is basically to track the benchmark, and it is very simple for a common man or for a common investor to track, that index. What is the index return, and then what is the ETF return? Here your return should be always in line with your benchmark, subject to TR and subject to tracking error, of course. But beyond two factors, the return should be very similar to that index, and that is easy for any investor to follow that. So that's one. And secondly, liquidity. Always you can buy or sell these ETFs in the market during the trading hours. So, and you are getting the real time INAV real time prices when you are buying. So let's say during the market, if you feel that right now market is down and you want to invest, you are not getting the end day NAV here. You are getting the real time NAV at that point of time. If market is down, you will get that NAV. So it depends at the time of buying or selling. You are getting the real time NAV, which is very, very important. Liquidity is also very, very important. So that always you get it on the exchange. I would like to add one thing here, which is very important for our investors to know, that liquidity, I must not see only from the volume point of view, because that liquidity, for liquidity, there is a market maker who will keep supplying whatever number of units you want, to buy on the screen. That's not a problem. Maybe initially when you will go and to buy at that point of time, you may see a small quantity, because or a small quantity, whatever that volume is there, but that does not matter. And whatever value you want to buy, the liquidity will be there's a ample liquidity on all our ETFs, so that issue you will never face. So because market makers is a job is to provide the bid and offer, and as much as you want, they can supply there's many units. So that's absolutely not a problem on the liquidity side. And these all ETFs are well diversified with the various strategies. So whatever fits in your let's say portfolio, accordingly you can decide that. But most of these strategies are well diversified as well. And most important, these all diversification you are getting at a very low cost. No need to say, and that HDFC is a most trusted brand for last 20 years, and we want to thank you for your support and your confidence on us. Multiple reasons for investing in HDFC ETFs. For example, process. We focus a lot on our basically process, what are the investment strategies, what are the risk management policies, and the process where our focus is always high. And as you know, that outcome of that process will be always tighter benchmark tracking, and minimum tracking error will be there because of that process. So if you really want the minimum tracking error, then your process should be very, very robust, and all your risk management policies also should be in line with that rules of the investment. Quickly on the funds, what is our investment objective? As I said, this is just, I mean, two strategies, which are the smart beta strategies, and it is very, very important. As I said, five best strategies, or you can say five most popular strategies. These are the two amongst them. I think I covered most of the key important parameters about these two ETFs. But as a summary, I would like to tell you one important thing, that these two strategies are complementary to each other. And as in the beginning also Ram have mentioned, that that is the attack and defense. So your momentum ETF will try to, I mean, basically attack and look at those stocks which have done better and which is having a tend to do better and which can do better in the future as well. At the same time, your defense strategy is used in the low vol index, I mean, where you are getting the stable return, or these are the stocks which are less volatile and who can generate better alpha during stress time. So both the strategies are very, very important, and I think you should, I mean, look at it. And here, one last thing, and higher average, I mean, rolling return compared to broad-based indices. So that's very, very important when you are investing in any broad-based indices. Of course, I mean, that allocation should be there. I'm not saying that you must not have that, but here to generate alpha, there has to be a certain portion where you are, I mean, investing through this smart beta strategies as well.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.